So Britannia is set to post its Q3 FY21 numbers, and we are expecting a good set of numbers from the company. Though obviously we believe that the best quarter is surely behind them, which we've seen in Q1 FY21. What a super growth that they've seen, but that was mainly due to the stocking up, pantry stocking, etc. And now that seems to be coming off, where we are seeing home consumption, out of home consumption is back. There's no more pantry stocking, so people are normalcy is coming back. And that surely does have an impact on Britannia, but doesn't mean it's a bad set of numbers. We're expecting a good set of numbers, but just what it was normally used to report. So in terms of the numbers, we're expecting revenues are expected to be up by around 7.5% and are expected to come in at 3,205 crores. While in terms of the profits, we're expecting a jump of 18% and it will be at around 435 crores. Margins, we're expecting a 210 basis point expansion, a very good expansion that we're expecting in margins, and the EBITDA margins are expected to come in at 18.7%. Volume growth, like I mentioned before, FMCG volume growth is very important. So volume growth is expected to be at around 7 to 8%. And in terms of volume growth, obviously we are seeing a bit of a slowdown compared to the last couple of quarters that we have seen. A sequential slowdown in volume growth, obviously because the growth rate overall is also reducing, that we're seeing, like I mentioned before, moderation in growth due to the pickup in home consumption. QSR space is coming back to normalcy. Street food is coming back. So all this coming back, out of home consumption increase. So in home consumption is surely reducing. So that means volume growth will now also move back towards the previous levels. And right now it's expected at around 7 to 8%. Last quarter it was 9%. Q1 it was 21%. Obviously that was the COVID growth that we were seeing, where home consumption, in-home consumption was a lot more. Now talking about margins, yes, we are expecting a good expansion of 210 basis points in terms of margins. That is because of the benign input costs that you look at, and mainly the main input costs are milk and wheat that have been quite benign. So because of that, we are seeing efficiencies, also the cost efficiencies, which are further aiding the margin. So we are expecting an expansion in terms of margins for good gross and EBITDA margins. EBITDA margins 18.7% is what our expectation is. Now obviously we are seeing an increase in the palm oil prices. There is some inflationary trends coming in there, but that is set off by the benign input cost. So that is why the overall expansion we are expecting. And in terms of overall the steady volume growth as well as the margin expansion, that is surely going to help the profits also to grow, and that is why an 18% growth in terms of profit. Now, what are the other factors that we will watch out for when it comes in terms of commentaries? The commentary on demand trends, what is the sustainability of growth that they are expecting to see? Any inflationary raw material costs, any trends coming in on that? What is the commentary on that, especially with palm oil prices increasing now? What are they expecting going forward? So that is something we'll watch out for in terms of the commentary coming in from the management.